All right, well, my name is Amy Bach, and I am very pleased to be moderating this esteemed panel. Just as pleased as I am to have been here yesterday and today, having amazing conversations with all these like-minded, insurance-focused and climate-focused, I don't know, geeks. I think most of us are now proud to use that term. So we will be talking about the sort of most pressing issue, I think, that underlies the conference, climate risk and escalating climate risk and insurance markets, how we're doing and what we need to be doing. So you can see, are we gonna do the bio slides for everybody? I'm happy to introduce folks, however you want to do it. But I'm going to give a little context while we are getting to know our panelists here. Do you want to? I can introduce them. It's fine. Okay. So just context before we get into who's here on the panel. I run a nonprofit organization called United Policyholders. We founded it in 1991. Our focus originally was on helping people navigate disaster recovery with a focus on making sure that they got all their insurance dollars as quickly as possible. From there, we quickly started to get into preparedness, trying to figure out, since after every disaster we find approximately 2/3, at least for wildfire disasters, 2/3 of the people didn't have enough insurance. So from early on, we were looking at other sources of recovery financing. But then as the situation with the market in what we went through Katrina, and then we went through Sandy, and my organization has had a lot of opportunity to see the flaws in the way that people prepare themselves by buying insurance, problems with the products. And so we've been monitoring the evolution of property insurance now for 32 years with a lot of my friends. Here we go. There's the esteemed panel. And there's a lot of people in this room that I have been working with over the years. And so just a little bit of history here. In 2006, I'm an official consumer representative to the National Association of Insurance Commissioners. There was a small group of hardy regulators that decided that the NAIC needed to do a climate risk disclosure survey because they wanted to make sure that insurance companies were paying attention and weren't going to be caught flat-footed when risks started to change associated with climate change. So I was part of the little band, merry band, that went around trying to convince the states to adopt it in their state and use it. So we all know insurance is regulated by the states. The federal government has a very important role, and you're going to hear a bit more from Stephen Seitz about that. But primarily, it is up to the states to regulate the property markets and set policy. And so we thought, great, okay, good. But at that time, I remember thinking, yeah, okay, yeah, we definitely don't want them to be flat-footed, but the more they pay attention, the more it's going to impact consumers, the more it's going to impact rates, its quality of the protection they're willing to sell, all that stuff. And so from the beginning, I think those of us on the consumer side were a little nervous, right? Of course, I'm an environmentalist. Of course, we want to be contributing to, to strategies to reduce the impact of climate change, but also worrying about what is this going to mean the more insurers pay attention. And there was a group called Ceres that has been very focused on an issue that's coming to the forefront now. Should insurers still be allowed to invest in fossil fuels, industries, and should they be continuing to underwrite the very some of the contributors to carbon and all the problems associated there? They were involved with that, and then in 2014, there was a book that came out, "This Changes Everything: Capitalism and the Climate," and I was asked to give a little comment, and yeah, sure, it doesn't look great for property insurance affordability and availability in this era. There's going to have to be a lot of work done to kind of rebalance things in the system. So that kind of brings us to where, in a way, where we are now, which is we do have obviously a national, in a lot of people's view, a national property insurance crisis. It's a lot worse in some areas than others, and there's a lot of people doing great work in this room, innovating. But the reality is that insurers' appetite for insuring property risk has shrunk. Prices have gone up. The reinsurance market has been hard now for a number of years. And what we are seeing is a lot less money flowing into disaster survivors' bank accounts from insurance than in the past, which compels government agencies to be creative and for us to all be here looking at, okay, what can we do? Because if you're a publicly traded insurer or you are a mutual and you have obligations to your investors and to your company to keep your doors open and be solvent, you're definitely going to have this conflict. When faced with the data around climate change, and particularly when faced with the increasing granularity and magnification of risk that technology is giving insurers. You know, the drone imagery, the predictive analytics, and all the tools now that insurers have that have magnified risk and understandably scared them. So that's the context I wanted to set. Obviously, the best news for all of us is all the energy and money that's going into risk reduction and mitigation. So with that being said, I want to get right to the panel, the national picture. Many regions of the country are experiencing a property insurance availability and affordability crisis. What effects are we seeing on the real estate and mortgage lending markets, and should we be concerned about systemic risks? And I'm going to turn first to somebody who has a very hard job, I think, Stephen Seitz, the head of the Federal Insurance Office under the U.S. Treasury. So Stephen, what effects are we seeing in the real estate and mortgage lending markets? Should we be concerned about systemic risk?
No, thank you, Amy. I mean, first, it's very nice to be with everyone here today, and thanks to you, Doug, and Carolyn for serving on our advisory committee at the Federal Insurance Office. We obviously appreciate your engagement with us in that forum. Work on climate-related financial risk is a top priority for the Biden-Harris administration, the Treasury Department, and the Federal Insurance Office. So it's great to see today a full two-day conference addressing these important issues. The interconnections that Amy mentioned between the banking, housing, and insurance sectors, it's top of mind for us at the Federal Insurance Office, and also through our own independent work, and then also through the work of the Financial Stability Oversight Council, where we serve as a non-voting member. As Amy alluded to, you are seeing rapidly increasing homeowner rates and the complexity of acquiring coverage. You're seeing some buyers be discouraged from buying coverage, which can potentially trigger a drop in their property values and then propagate through the financial system to the housing and the banking sectors. In addition, there's a growing risk of homeowners, actually not even purchasing coverage. Some of the recent information we've seen, says that almost 12% of homeowners do not have insurance coverage. And half of that 12% is making less than $40,000 a year. So I think our top line point here is, more work is needed at the state and federal level, looking at these interconnections. It's obviously a very complex issue, but from the Federal Insurance Office's perspective, and I think we'll get to this later, we're trying to create a nationwide picture of the issues through some of our authorities that we have, I think particularly at a more granular level of information. That's one area of focus for us has been a lot of the data that's publicly available is at a state or a national level, and we proposed a data call last October, seeking homeowners insurance information on a variety of fields at the zip code level, because we're increasingly seeing localized impacts of climate events, and particularly you're seeing some of the carriers pulling out of specific high-risk areas across the country. And obviously those issues have been magnified recently with the events in California. You've obviously seen a lot of market stress in Florida over the last several years. So I think our work going forward is critical to kind of informing that national perspective, but at the same time being cognizant of the state role for regulating insurance.
Thank you. So Professor Keyes, should we be concerned about under and uninsured mortgage?
Yeah, absolutely. Thanks so much for having me. My name is Ben Keyes. I'm a professor of real estate and finance at the Wharton School at the University of Pennsylvania, and come at this question much more from the side of thinking about property markets and mortgage markets. And in many cases, those markets would love to never think about insurance or think about insurance as little as possible. And so I'm going to offend as many of people in the room as possible to say that they think about it like plumbing, right? When it works well, you don't give it a second thought. And what we're seeing now with rising insurance rates is we're seeing issues for households looking for more affordable options and alternatives. And we're seeing mortgage lenders now getting quite a bit concerned about under insurance, that, you know, when are they going to be exposed in this process? And I've been trying to get out of the ivory tower and have more conversations with industry recently. And I spoke with a mortgage lender earlier this week who said that about 10 to 15% of the mortgage applications they get, they're actually sending them back to the home buyer to say, actually, you need more insurance coverage than what you currently have budgeted for, in the ways in which households are crunched in this incredible affordability crisis that we're in. Rates are very high, prices are very high. This is adding one more real burden to households. They're looking for ways to cut corners any way they can, and cheaper insurance options from a shadier insurance provider who's offering less coverage is one way to do that, and we're now seeing mortgage lenders pushing back pretty aggressively. So I think there are a number of ways in which we should be worried about this. And as we think about the players in this space, we need to remember, I don't think I'm speaking that loudly, but it's really echoing. I'm going to move back. As we're thinking about the players in this space, we need to remember that the mortgage market is largely nationalized. Over 3/4 of the market are going through the pipelines of Fannie, Freddie, and the FHA. And they have a lot of control and input in what gets fed through that pipeline. And we're seeing just in the last couple of years a real newfound concern about their exposure to these risks. They've all formed working groups to focus on these issues, and I think we're going to see more action in the choices that they make going forward.
So I think just to again contextualize here, if you have a mortgage from a federally backed bank, right, federally insured lender, then there's a congressional rule that you must have insurance. So it's a little. I sometimes wonder about this analogy to the requirement that if you've gotten benefits after a flood, that you then are required to buy insurance, or so that just for people who don't have a federally backed a loan with a federally backed bank, so they don't have to have insurance, right? So we have this whole world of people now. You heard mention this 12% figure. So there's that universe. So the people who actually do have a mortgage, you have two issues. If I hear you saying, you have the issue of, are they complying, and then do they have enough insurance? Now, you know, the whole underinsurance phenomenon, which I kind of referenced to in my little intro, you know, that was sort of a first imperative for us. It's like, oh my God, all these people after floods, after wildfires, you know, after hurricanes, derechos, you know, they didn't, for various reasons, fine print or couldn't afford or what have you, don't actually have coverage for that particular risk. But for people who have a mortgage and they have insurance, and then they are told that they have to adjust, what does that do on the consumer? What does that do?
Yeah, I mean, it just very directly raises their monthly cost, right? Their budgets are going to be that much more squeezed in terms of how much they're spending each month on principal, insurance, taxes, and interest. And so it's you know, it doesn't seem like it's a deal breaker at this point for many of the people at this mortgage lender. They can go back and find another policy, but for some people, they're going to have to change the houses that they can consider in their set of possible homes to buy.
And okay, and let's talk for a minute about forced place. So if everybody here is familiar with it, it's
Well, sure, thank you, and happy to be here. I'm Doug Heller with the Consumer Federation of America. I'll just say this about forced place. So this is the product that when somebody loses their coverage because they don't pay for their policy and it's canceled, the lender will place a policy on behalf of to protect the asset for themselves. Typically, it only benefits the lender. In other words, if there is a disaster, the homeowner isn't going to get the benefit of it. It's going to go to the bank. There is no broader use of this policy. They're very expensive policies. So we've been looking, and the data aren't really easily accessible. There does seem to be a little bit of creep up increase in forced placed policies right now, but we haven't been able to really determine it if it's just sort of a bump in the road or not. It looks like it's more in the western states from what we've seen. But this is an extremely concerning product, and it's very, very expensive, and it shows up not as a separate bill, but it shows up in your mortgage payment. And so suddenly your mortgage payment has increased on a monthly basis. And it's shocking to people. But the problem is they weren't able to afford the coverage that protected them. Now they're being forced to pay for coverage that doesn't protect them. So it's kind of a worst case scenario, except for the banks who themselves are sure to be protected.
Yeah, and in our struggle to help consumers be able to continue to protect their assets, both home and small business. We've been looking at every solution, right? Looking at parametric, looking at, of course, the states supported residual market plans are increasingly important in a lot of states. But we have thought. I had a few people come to us and say, "What about forced place? Could there be a way of improving those products? Maybe could it be cheaper? Could it be built into your mortgage? Could it be, could it protect somehow the property owner and not just the lender?" So typically these forced place policies only cover the amount of the loan. And they're very, very thin in terms of the coverage, and they're expensive for what you get. And I thought, oh, gee, I wonder. And in our search for solutions here, right, in this room, yesterday we talked about, well, we want to avoid increasing debt. That's a concern with forced place policies, is it increases your debt. But then I thought, well, is there any opportunity here for the banks to help here? Because maybe it could be cheaper to provide forced place without there being an agent or a commission, maybe. So these are just things that people are thinking about. But generally, when you say the word forced place, to anybody who's got an orientation towards consumers, they'll say, oh my God, no, those products are, just a ripoff. So it's just to, put it bluntly, as I'm known for doing. Okay. Let's go to the next question, and it's a good segue when Doug was saying sometimes it's hard to get data. Okay. About what actually is going on in the market, with this escalating risk. How much do we know about the markets, the insurance markets across the country? So FIO, and partly I think in response originally to a request from Senator Feinstein years ago saying the wildfire insurance market in California has really gone haywire. I would really like FIO to look at this, and I don't know, maybe the data call preceded that. You can tell us, Director Seitz. FIO issued an important insurance supervision and regulation of, has been preparing to launch a national data call to determine how climate change is impacting property insurance availability and affordability. The NEIC recently announced a similar effort. Director Seitz, what is the current status of these national data gathering efforts, and are they being coordinated?
No, thanks, Amy. Happy to provide sort of an update on where FIO's work. As you alluded to, we did issue a report at the end of June with an event at Brookings with some of you there, issuing our recommendations on how the state insurance regulatory and supervisory system can be improved. And happy to talk about that maybe later. But here I would just focus on the proposed data call we did in October. And both of those initiatives, they stem from President Biden's May 2021 executive order on climate-related financial risk. And in that executive order, he called on FIO to assess the potential for major disruptions of private insurance coverage in areas of the country that are most vulnerable to climate change. And as climate-related impacts have increased in frequency and severity over the last several years, we are seeing, as I mentioned, insurers increasingly pulling back from high-risk areas. And most often that has the biggest impact on the disadvantaged communities who do not have the ability, as I think Doug was mentioning, to find insurance and other matters. It creates a real bottom-line pocketbook issue for a lot of consumers. And our work with the proposed data call is looking to find a nationwide perspective on this issue and looking at how our homeowners insurance markets are being affected. As I mentioned, the current publicly available data, it's available at the national or the state level. And there's limited data available at a more granular basis. And as we've seen, the effects of climate change and climate-related events, they're at a localized level. Particularly, you've seen carriers pulling out of certain zip codes. And our proposed data collection from last year, it would provide consistent, granular, and comparable homeowners insurance data on a nationwide level. And we think this is critical to establishing a national framework to understand how climate-related financial risks are impacting families and individuals across the U.S., and how it could also affect the broader financial system. As Amy mentioned, the NAIC has also begun scoping its own potential data call, looking at issues of affordability and availability of insurance coverage. Some of the issues they've cited are, the extreme weather, increased reinsurance costs, and also inflationary pressures. Our efforts, they do share similar goals. I think we're very pleased to see the NAIC and the state insurance regulators, publicly recognizing the importance of granular insurance data to better understand and assess these issues. We have been discussing potential coordination and collaboration with the NAIC, but at the same time, recognize, their need to embark on their own policy process as well. We're going to continue to engage with the NAIC in the states, I think in particular, cognizant of trying to mitigate any burdens through both of our processes, but at the same time, being cognizant of our distinct roles and authorities. I would just reiterate, I think from our perspective, a more detailed and comprehensive nationwide assessment of these issues is needed for us to adequately respond to some of the areas that we've been seeing. It's a priority issue for Treasury and the Federal Insurance Office, and with that in mind, we intend to proceed with our next steps in implementing our own proposed data collection to help establish that national framework, and I think we're looking forward to more to sharing in the weeks and months ahead on that front.
Thank you. Are you able to speak to whether your data gathering will elicit information on the growth in lender force-placed policies?
I can't speak to the specifics of the proposal, but maybe I'll just reiterate our proposal last October. It focused on single-family homeowners multi-peril policies, right? And there's obviously additional information on the force place. There's additional information on the excess surplus lines and non-admitted carriers. And that is an area that we highlighted in the report from June, was the need for the states to put more monitoring and more focus on those markets. Like, how are they growing? What are the effects on consumers? And then what are the carry-on effects through the state system and then also through the federal, financial architecture?
Okay, and just another little context point here. So one of the phenomena that we're seeing in California, Louisiana, Florida, and other states is a reduction in the policy count for admitted insurers and an increase in the market share that's being held by non-admitted. There, as always in insurance, there's several different different labels for the same thing. Non-admitted, excess surplus, E&S, people call them different things. So, Doug, do we know enough about what's happening in the excess surplus market?
No. The answer is no. But just very briefly, because I think Stephen was very generous about the process here in terms of the NAIC sort of doing its work. I want to be very clear. The reason that FIO, it's so essential that FIO and federal government starts looking at the data, including the surplus lines data, is because there was a black hole where data collection was supposed to be from the states and the National Association of Insurance Commissioners. They fell down on the job of collecting the data that they were supposed to do, and so it's absolutely critical that we do it. And if this creates some competition, sort of turf competition, great, because that marketplace will foster more data that will be useful. Very briefly on the surplus lines, just from a consumer perspective, it becomes very concerning when people can't find themselves in the traditional admitted insurance market, the one that most of us know in terms of how we get our home or renter's insurance, and they instead go to these surplus lines because, importantly, they're not as well regulated, not really overseen in the same way. The sales are, but not the products. And most critically, they're not backed by the guarantee funds. So when they go under, and because a big flood or a storm comes through and decimates their capital, and they can't pay all their claims, the homeowner can't then turn to the guarantee fund of the state to cover that. And that becomes a serious problem when a big disaster hits. So we have to be very concerned about that, which means we need to understand what's happening in the market.
Yeah, and again, United Policyholders, we've been doing these shopping help webinars there out in California, and about every 6 months, and every time I have to shrink the list of companies that are possibly an option for people. But we had to spend a lot of time trying to figure out how do we guide consumers on, ensuring your biggest asset. For most people, their home is their biggest asset through a brand you've never heard of, and then helping them understand that if they go with one of these non-admitted companies, it's not protected by a solvency fund. Either of the professors, do you have any observations that you want to share about this concept that there's a larger share of risk being held in companies that are not protected by solvency funds?
I'm Ben Collier. I'm a risk management insurance professor. Thank you for having me. I'm in the Fox School of Business at Temple University. I think this point is a great one when we move out of this regulatory oversight, run into concerns about what will happen to consumers, capital supervision, and so on. So I think it becomes more of a black box, and then you don't discover the problems here until after the event when people's lives are trying to rebuild.
Okay. Let's move to insurer actions and the consumer impact, which you just mentioned. In reaction to climate change, we're seeing insurers increasingly replacing traditional set dollar amount deductibles with percentage, split, multiple, and high deductibles, limiting coverage for mold, hail, smoke, water damage, in addition to already excluded flood, earth movement, and earthquake damage. This means that an increasing number of disaster-impacted home and business owners have no access to insurance funds to pay for repairs. For example, nearly a third of Hurricane Ian claims were denied without payment. Given that states regulate insurance forms, is there anything Congress could do to limit deductibles or set required minimum coverages? Ben Collier, let's start with you.
I think to step back just a second on this question, we would expect that given the current housing stock, costs to go up over time of insuring these houses. This is sort of inevitable. I think some of the questions are how quickly and what's the path to get there. And these, we've seen all this national attention on these insurers exiting markets, being unwilling to write risks at the prices they're able to charge. And we've seen I think there's a couple of different outcomes we might observe in the future related to this based on what we already see in the US. So one model is that when a certain risk gets really large in a state, sometimes it gets carved off of homeowners insurance. You see this in Texas, for example. If you want coverage for wind and hailstorm, some property owners have to go to a state provider of that. In some cases, it's an amendment to their existing policy. Flood, of course, is already this way. And so I think there are open questions here about what happens to things like wildfire, where there's a huge variation in risk. And you can even think in the same state, as Stephen was noting earlier, there's a huge variation in who's exposed to this risk. And with separate policies, insurers have more capacity than under homeowners to charge varying rates. One of the other things that we see with those separate policies, though, is people buy them a lot less often. Businesses buy them less often. So after a big event, you'll see households and businesses without flood insurance, without wind coverage, and so on. And for whatever reason, the institutional function of the mortgage provider insuring those insurance products, or making sure you have those insurance products, doesn't work as well for the one-off ones. So, I mean, I think the cost motivation is leading to insurers being less generous or having higher deductibles or whatever else. But a specific concern that I would have in this context is carving off some of the risks that you're most exposed to, and that your insurance isn't covering that, and fewer people in a place like California are being covered for wildfire. I think the other view of the world in the future is something like what we see in Florida, where a lot of the primary insurers have left, and we have more pressure on a state-run program, less competition, less products offered, less competitive pricing potentially, and those are potential states of the world, I guess, we could see in more places in the U.S. So I'm getting around to your question eventually.
That's okay.
Here,
Take your time.
Which is
this is the big question, really, right?
Which is
okay.
And so part of the concern, I think, if you're saying the reason that part of what's happening, I think, with these insurers that are making national headlines saying we're not going to participate is they're not able to charge prices to reflect the risks, at least according to their view of the risk. And so if we have federal requirements, for example, that deductibles have to be at a certain level, or coverage has to be at a certain level where it's lower deductibles and higher coverage, these have to push prices up. And so if we have then like consumers unwilling to pay those or regulators unwilling to accept those higher prices, I think what you end up with is less insurance supply. And that makes for a really tricky addition here. So I'm not sure that requiring federally that certain coverages are deductibles and coverage limits are essential is the solution for the problems that we're seeing emerge.
So I want to hear from other panelists, and starting with Doug, and just if it's possible for any of you to touch on this. Some people have said, well, you know, in the Affordable Care Act, we mandated essential benefits. Should we be doing that with property? But Doug, do you want to speak to, is there anything Congress could do to limit deductibles or set required minimum coverages?
Well, so I promise to answer that. I'm going to actually pull back even a little bit further than Ben did, though, because as I'm listening to you talk, I think that we have to grapple with really the fundamental question. It came up a lot yesterday, and I really appreciate the work that EDF has done to sort of set this bigger picture, which is when we are when we are sort of increasing deductibles or doing these split limits or exclusions, or when we're splitting off coverages entirely so people have to buy, I buy 3 home property insurance policies to protect my home. I live in California, so I've got home, earthquake, and flood. So when we start doing that, what we're doing is we are reducing insurers' exposure, right, to the risk, but we are not fundamentally reducing the risk. And the problem that you're describing, Ben, is that we still have this ever-growing risk because of climate change. And so we need to think about what we were talking about yesterday, which is focusing on lowering the risk, not simply taking the very powerful industry that kind of manages it all for us and let them relieve themselves of some of the burden. Because what we're just doing then is we're just doing risk transfer back to consumers and communities, and we're going to be left with the same kind of disastrous consequences that we're trying to avoid. And one of the dangerous effects of this, and this is why I do think that, you know, whether or not Congress writes the law or just tries to create that public policy competition that Stephen has helped create with FIO's data call, maybe not, that wasn't the purpose. The purpose was get the data. But I think one of the dangerous effects of all of this has been sort of this growing sort of sense, and insurance industry is training us, and I was hearing it in conversations yesterday, to think of insurance as just a way to kind of protect the asset, like at the big picture level. But really, we buy homeowners insurance as consumers or renters insurance, not just in case the worst catastrophe comes and we want to make sure we have 2/3 of the ability to build back, but also because we have other claims that are smaller, other incidents. And if we start thinking that we can't use our policy, if we file a claim, we're not going to get it. If we use our policy, it's going to cost us too much. We have to be able to think about risk transfer again and make sure that consumers and communities can afford to own homes or, you know, protect whatever they have as tenants. And so I just think that this is the wrong way to be dealing with the climate-related disaster crisis, by thinking, okay, we're just going to sort of slough off the protection that is available. And so we really need to be starting we should be trying to preserve the risk transfer equation, and we're focusing on the mitigation to reduce those losses so we can have affordable coverage, so we can actually build those coverages back in. I shouldn't have to buy 3 policies to cover my home. There should be a policy that covers the risk that owning a home has, and that's what we need to be thinking big picture about. And so I'm happy if Congress wants to say, okay, and like Dan Schwartz yesterday talked about standard coverages, like so we all can understand it. In healthcare, we kind of have a couple of different, you know, bronze, silver, and platinum policy. Right. We want to have some standard coverage, standardization. I think that's great, and if Congress can start that conversation because it's not happening sufficiently at the states, I'm happy to indulge that and build a little bit of policy competition.
Any other panel members want to riff on this?
I guess I'll just chime in to say, I think just building on what Doug just said, and it points to this, I think that the next question then is, you know, thinking about whether the risk is being priced and who's bearing that price. So what you're describing is potentially a higher standard of policies, and that's going to be a higher price, and it's going to immediately bump into this trade-off of risk-based pricing, where I know I'm kind of jumping the list of questions that we had, but okay, as we're thinking about this, we want risk to price to reflect risk. We want premiums. My mic is buzzing in a way that no one else's mic is buzzing. We want, maybe it's just me, we want prices to reflect risk. We want decisions to shift away from risky behavior and reduce and mitigate risks. And the price mechanism is going to be the signal that goes to home builders, that goes to consumers, that goes to banks and lenders to say, hey, this is a risky place. We shouldn't develop in the same ways that we did previously. And anything we do to reduce the transmission of that signal is going to reduce the amount of risk mitigation that we take. So we're going to face a really fundamental trade-off where that's going to raise costs. There's been a lot of pressure to say, hey, we can't raise costs this much, especially against vulnerable populations. And you certainly see this with the pushback against risk rating 2.0 that's happening right now in the NFIP. We see a path towards something that looks like more actuarially fair pricing, and there's an outcry. And so I think there's a fundamental tension there in thinking about how much are we going to price this risk and force households and everyone sort of in the chain to bear those risks, and how much are we going to subsidize it. And so if we're going to set those minimum standards for a policy, there's also going to be the temptation to substantially subsidize those policies and substantially subsidize living in risky places even further, and that's going to dampen the incentives for us to mitigate and shift where we're building.
Yeah, I think we've got so many really big, important themes going here. The price signal, I think a lot of environmental groups early on, we all appreciated the fact that insurers were one of the first sectors to say climate change out loud in a public room, and to not play political games about it. And I think a lot of environmental groups, early on recognized, as we heard earlier today, that insurers can be great partners in the effort to deter building in areas that are now more vulnerable. But we're not, I don't know, are we seeing the price signal working? We heard a little bit yesterday about developers continuing to build. Anybody want to speak to that?
I mean, I think one of the challenges here is how consumers think about their insurance fundamentally, and I guess I have doubts that consumers necessarily understand what costs go into their products. So coming back to that point that costs have to go up over time, when people look at the new premiums that they're offered, I'm not sure if they understand the economist's view of thinking about the expected loss is foundational here, or even if they're able to calculate that expected loss on their property. I have done some research on severe repetitive loss properties. These are the riskiest properties in the NFIP. Thanks to Rob, who shared some data with me and who's done a lot of nice work in this area. So one of the things that happened in Biggert Waters about 10 years ago is prices went up on SRL properties. And at that time, they sent them a letter. They said, hey, look, you live in a property that's one of the riskiest properties out there. So you're in the top 1% here in terms of risk. That's not a good 1% to be in. We're going to increase premiums, but they're never going to exceed the full risk rate on your property. So telling them specifically about the costs relative to premiums, about a quarter of people dropped their insurance as a result of this. And these are people who had lived through floods in the past. And I mean, I think this idea of going bare, I think that's telling because this is subsidized insurance in this context and a high-risk group, and that people who are looking for insurance on the private market are not going to get that same information from their insurers, and they're going to see prices go up. And as Stephen was saying, in some cases, this is about, can I buy the insurance or put food on the table? Or there's a lot of affordability issue concerns here as well, where lower income properties, policyholders or older folks who've paid off their mortgage are maybe especially likely to do this.
Yeah, so we did kind of jump into this next question. There's been quite a lot of recent media coverage of the phenomenon of property owners opting to go bare because they've paid off their mortgages and can't or don't want to pay current home or flood insurance premiums. What are the implications of this phenomenon? So either, Professor, go ahead, Director Seiss.
Yeah, sure. Just one quick point. In our June report on insurance regulation and supervision, we broke it down into the three main categories of insurance regulation. So you have your prudential issues, you have your macro-prudential issues, and your market conduct. On the first bucket, there are states that have really started to incorporate climate-related risk guidance into their oversight of the insurance sector. And that was an area we really focused on, use that as a good example, whether it be what New York DFS has done or some of the other states have taken steps. Also just wanted to highlight on the macro-prudential sense, what you're hearing here today is the need, and it's something we emphasized in the report, to be monitoring these different markets on a state-by-state basis. It's not just your standard HO3 policy. It is looking at where are the other markets growing. For example, in California, where are those homeowners that are not being covered by the top players, where are they going to go? Are they going to go to the fair plan? Are they going to go to smaller local carriers? So those are issues that we really think should be prioritized. And then third, just to sort of emphasize what this panel has been talking about, we also had recommendations highlighting the need for better efforts at consumer education and mitigation. I think particularly on the consumer education front, we talked about the need for the NAIC, the states, the federal government, the sector, the Financial Literacy Commission at Treasury chairs to help homeowners understand what's in and what is not in their policies. It's an area that we found a lot of confusion among consumers. And then second, also the importance of mitigation. And obviously, Roy will speak next, and IBHS has done a lot of great work here, but it's an area that I know we're very focused on, not just in FIO, but across the federal government, is how do you sort of amplify the mitigation work that can be done to reduce the risk on the front end. So those are two of the big, I think, consumer areas I just wanted to highlight that we tried to emphasize in our work, and it doesn't maybe get as much attention as some of the macro-prudential or the micro-prudential regulatory issues, but those two components are really fundamental to trying to solve some of the issues we're talking about.
This phenomenon of people going bare, we care about it regardless, right? We care about our fellow humans, we hope, right? But we talk about caring about people who have a mortgage, making sure that they comply with the terms and maintain insurance, partly because the banks are insured by the FDIC, which in turn is supported by taxpayers. So a lot of that concern is, fiscal integrity and safety. But then the people who go bare and don't have either because they don't have a mortgage and no one's making them, what's happening to those folks? Professor Collier, go.
So that's a challenging question because there's a lot of different things that happen to those people. And I think part of it you should think about relating to things like income. If you're better off, you may have retirement savings or other resources you can use, access to a private loan, that if you don't have as much income, you have fewer access to all of these. I think another common misconception is the generosity of federal programs. Carolyn's done a lot of work on this as well. Ben Keys and I have some papers together. We're buddies and both named Ben at the same time and on the panel together, where the FEMA grant program is trying to get people's homes safe again and not fully compensating them or replacing their property as it was. And only about a quarter of people that apply for FEMA grants get FEMA grants. I've worked a lot in the disaster loan program, the SBA low interest loan program, and about half of people that apply for those loans don't get those loans either. So some of the work that Ben and I have done together is looking at what happens to people that don't receive those loans versus do. And if you don't receive one of those loans, you're more likely to declare bankruptcy in the future. We have people's credit reports that we're looking at in this process, and we're seeing effects 3 and 4 years after the event, persistent effects. And I think part of the concern here is that if you have this huge funding need that you can't address anywhere else, you don't have insurance for it, you don't have $80,000 in the bank, that this horrible event that you went through, that liquidity crunch is going to exacerbate the problems. And so you're going to fall behind on existing debt. You may have to foreclose or file bankruptcy and so on. And so I think this is some of the concerns where if you don't have those funds in place, a bad situation becomes a horrible situation.
Yeah. Doug, did you want to add something?
It's something that's a little afield, but you just made me think about it. And I think it's important for us to remember when we're thinking about equity in access to insurance and affordability. So that same person who, for various reasons, had to go bare for some time and then found themselves in this cycle with their credit falling, let's not forget that when they ever try to go back to get home insurance, or maybe they're a tenant, they're going to now pay 40, 60, 100% more premiums simply because they have that credit score has been hit. And the insurance markets are still pricing people on their base of credit. And we see very clearly lower income homeowners, Black, brown, indigenous homeowners have lower credit. So they're facing higher premiums in addition to whatever the risk that is being driven by climate change and others. So you have this cycle that reinforces the poverty and reinforces the lack of access to protection. And so I think it's important that there are sort of big sort of public policy levers and sort of smaller ones, and there are kind of these like in the little sort of weeds of it all, there are some places that we can provide some relief. And it gets to, well, is it okay to be spreading risk more than we do? And if I could just sort of use one extra second on, sure. It's going to be more than 1 second, but because this is something, So the purpose of insurance is not to segment risk. The purpose of insurance is to pool risk, and most people actually believe that. Insurance companies don't believe that, but most people do. I want to offload this risk that I can't handle because I do want to own a home, or I do want to have my refrigerator protected in my apartment. So I want to offload that risk. That's what I care about. And so, and when we think about climate risk, the dramatic increase in risk is not because people are living, on the sort of coastal areas of Texas and they need to go to the windstorm, or they're subject to the wildfires in the wildland urban interface. It's not because of that. It's because of 150 years of social, economic, industrial plans that have led to increased risk in the places where people have lived by choice, by redlining, by other obligations. So we have to recognize that this explosion in risk is not the fault. Now, you have repetitive losses, we've got to do some education. You've got new building, we need to have land use, because otherwise our land use and housing decisions are being made by the underwriters and raters at insurance companies rather than as a matter of public policy. So I just think that, and the point is that we do have to come back to recognizing that this is a shared experience. And if we're going to address the high costs, we have to think about being able to spread the risk more effectively rather than just at this very targeted. And that's what we're seeing right now, is this targeted attack on people who are the victims of 150 years of industrialization. Now, it doesn't mean there are all the wonderful benefits that we have, but let's recognize that that's there's shared causation as well. So.
Well, this is a juicy topic, right? Right. Very, very. So look, we talked about price signals. We talked about, there's a difference, I believe, between people who have been living somewhere for a very long time and then the risk has increased versus people who come to the risk. But that's sort of a whole, probably, I don't think we're gonna get maybe to that. But I wanna, because we're talking about sort of, we're all in this together, and part of the problem that we're experiencing now is that the technological tools that are available to insurers today are allowing them to really segment risks in ways that they didn't used to do, right? Very individual, very, very granular underwriting, right? We're seeing a lot more of that. So here we are, all the states together, we're, the United States. Director Seitz, what are some solutions that Congress and the states should be considering to stabilize and strengthen property insurance markets and increase or restore available home and business coverage? For example, should Congress be prioritizing the creation of programs similar to TRIA? Let's start with that. The other question, if we get to it, what about expanding the NFIP to include more than just flood risk? I haven't gotten anybody really excited about that, but Director Seitz, for example, should Congress be prioritizing the creation of a program similar to TRIA?
Well, first I'll let others speak to potential considerations for Congress. I think maybe I'll just stick to kind of a few things we've been highlighting in this area. First, the improved granular nature of insurance data is critical. No matter where you go in this conversation, everybody wants increased data. Right now, the insurance companies have granular data, and that's an area you see time and time again, and we emphasize that throughout the report, the need for some type of consistent, comparable granular data. Second, I would say increased monitoring at the state level on some of these issues that people have been highlighting. Particularly, you're looking at, the reinsurance market, right? That's an area where you've seen significant tightening, hardening, and then that has carry-on effects to the availability of primary coverage in certain states and has carry-on effects to the affordability and availability for consumers. And then third, I would just say there's a lot of, I think, innovative thought occurring. Particularly, you look at the work that Carolyn was doing with some of the organizations in New York. It's not necessarily called parametric insurance, but it is a parametric type product. I think that's an area we spent some time looking at as well. And it's really an issue that we have not seen, I think, really get, the states, I think, are still looking through the legality and the legal issues of parametric insurance. And I would be curious to sort of just hear, I think, after this, how that's been progressing with some of the work.
I want to make sure we have time for questions, but I do wanted to give either of the Bens a chance maybe to address this question of, I don't know if either of you were involved in the creation of TRIA. Obviously, TRIA has gotten it got done, so that was good, but it hasn't actually paid any claims. Do either of you want to talk about whether a TRIA-like entity is in order here to back up property markets.
We're too young to have been involved in
Yeah,
TRIA.
okay,
This
there
is a
you go.
20-year-old program, but I want to come back to something that I learned from Jerry Skis, one of our last panelists, which is that like when you're thinking about where government should be involved, we often need to think about like where's the market failure, what's the market having trouble covering, and I think that the point of TRIA was that the insurance industry was especially worried about events like 9/11, these huge tail risk type events. They didn't know how to price it. They didn't have the financing to cover a potentially another large terrorist attack like that. So there are certainly opportunities to pool climate-related risks at the national level, and a setting like that sort of maybe is sort of in line with what Doug was saying earlier. I think part of the concern, from homeowners insurance providers is where do we get good pricing for this risk, or where do we take advantage of national pooling? And so, I think the idea that we wouldn't necessarily want to think about a model like expanding the NFIP where the primary provider, the direct provider of insurance is the national government, but that the government might fit in financing and managing tail risks instead.
Okay, Doug?
Thanks. I think we have our timing is coming. We're running up in timing, but you just made a really interesting point about sort of whether or not expanding the NFIP. So government is really good at doing the infrastructure stuff, the things that allows commerce to happen. We build roads, we don't build cars. And I actually think of TRIA, when Wall Street was threatened with this insurability crisis, government within a year developed this massive sort of facility to protect Wall Street. I mean, literally Wall Street because of 9/11, where it is. And so we have an existential crisis through climate change now that probably has creating more exposure than terrorism. And so the question is that where government really can fit in as an infrastructure, sort of a backing up? And so think about NFIP, that's more like building a car. And maybe what we need to be thinking about is building the roads and the reinsurance facility that will take some of the exposure off the top of the insurance companies that are saying, I'm not going to do wildfire in California, or we're going to be moving away because of all these derechos that are going through Iowa, or what have you. Maybe if we can take that most catastrophic, the mega catastrophic exposure off of the books of insurance companies, they have a better sense of what their real probable maximum loss is. Then they can actually build what we were talking about earlier, is this idea of a more comprehensive insurance product, better spreading around the country and mixing the risks. And so I think that we have to think about what is the best role of government. Is it really being the building of the cars and selling of a flood insurance policy to homeowners? Or is it building the roads, creating the commerce by having a system like a TRIA that applies to making home and renters insurance and even in small business property insurance available? And I think that there's a real opportunity there. And if we could do it for Wall Street, we should do it for Main Street.
I couldn't agree with you more. And I think that TRIA, that's why I brought it up, because I think those of us who are in the trenches know that the hard reinsurance market and reinsurance challenges are a big driver of the reduced availability and affordability of many insurance products. So given the fact that we got it done, I feel like we could do it again. Let's get to risk-based pricing, and then we'll see if we can squeeze one more in, and then we'll get to questions. So be thinking about your questions. So coastal and wildfire-prone homeowners are bearing the heaviest burden of skyrocketing insurance premiums, and some people say that's fine. They shouldn't be living in harm's way. People who didn't come to the risk in that they were living there before climate change began to manifest get preferred pricing over people who purchased or built in these regions knowing the risk was higher. So is that what we did with Risk 2.0? Ben Keys, do you want to start on that?
Yeah, and the sign is up that says 1 minute remaining. We could spend literally all day on this one. I think as we think about just tying this back to housing and mortgage markets, Fannie and Freddie choose not to price regional risk. They charge the same interest rates across the country, regardless of where you live, for the same credit score and the same down payment. And that's a political choice, and it's one that they've considered revising in the past. When there were delays in the foreclosure pipeline, they floated this trial balloon, hey, maybe we should charge different rates for different states, and guess what happened? The next day, the senators in those states said, this is you're harming our constituents. So there's just a fundamental political tension with these kinds of questions in terms of how much we can risk-based price and how much we can. And I think as we're thinking about proposing additional kind of tools for the government to be involved in, and we're seeing the growth of these FAIR plans, I think we have to question the political will to charge people the right price to get them out of harm's way.
Well, okay, so I must have miscalculated. I thought we still had another few minutes. One more question, okay. So can I allow an audience question, or? Okay, so what I'd love to do, because there's so many big brains in the room, and this is to me, is sort of, this panel is a real core facet of the challenge, but I don't want to take time away from the next panel, which is incredibly important, my good friend Roy. So, how can we avoid pitting urban versus rural and coastal versus inland Americans? I have Ben Keys and Doug on this one, but any of you are welcome to jump in.
I'll say very quickly, climate-related risk is happening everywhere, right? We are all in this. I mean, I mentioned the derechos. There was 14 states impacted by these massive destructive winds. We had a tropical storm that hit me in LA and an earthquake at the same time. There wasn't a wildfire because the rains were coming down. But this is happening everywhere. So I just think that we have to recognize that this is not an urban, coastal versus inland, rural. This is an American problem. It's a global problem, and so we're going to have to approach it. And that's why I think thinking about this as a shared risk, a shared problem, is so critical. And we shouldn't be talking about we're paying for them. We are all in this together.
Right. So I would love to have a round of applause for this awesome panel. No time for questions. Carolyn? Do we need to?